Today we're going to talk about an important topic that doesn't come up very often, but comes up a lot when we talk to our financial advisors and insurance folks that we work so closely with. The reality is that you can put life insurance in a cash balance plan. Now at Emparion, we're third-party administrators, we're TPAs, we're not financial advisors, we're not insurance brokers, but we are approached often by insurance agents as well as financial advisors when it comes to discussing how to structure a plan for a client. And insurance often comes in as one of the equations. Insurance is actually used in a cash balance plan very often, and we use it a lot with our advisors in plans. And they work very well for some folks, not perfect for everybody, but for the right client, it actually works very well. So let's take a look at what client is going to make most sense to put insurance into the plan itself. First of all, you would look to any sort of business owners who want the benefits of life insurance, but also are interested in the tax deduction side of it. Next, we want to look at any individuals who want to maximize retirement plan contributions. The key thing being, depending on how the plan is structured, you can put a little bit more into the plan sometimes when you fund it with life insurance. Next, we want to consider it for individuals who may not have the best rating when it comes to insurance and would like the tax deduction to offset any increased premium costs. We also would have individuals who would like the insurance combined with the retirement plan and are on a limited cash budget. They want to be able to have the life insurance, but also put money into a retirement plan. This allows them to combine the two. Lastly, they're very good for business owners who would like to fund a buy-sell agreement and again, get that tax deduction where there's another business owner that's involved in the business itself. Now that we understand the ideal candidate for funding life insurance in a cash balance plan, nice to take a look at some of the specific guidelines that they need to uphold. The one that's most important is the fact that what we would call the 50% test. And essentially, when you look at your total contributions into the plan, upwards of 50% of those contributions, or no more than 50% of those contributions, should be into life insurance itself. You need to be very critical that when you meet all the funding deadlines. It's much more critical to make sure that you have the actuary involved, because there is a portion of this that's going to result in a 1099 out to the individual recipients of the life insurance and who's funding it every year, and make sure that you understand any of the benefits that you're going to be receiving from the life insurance, because at some point this is going to be rolled over into an IRA more often than not, and life insurance can't be used in IRAs. So at some point, the cash surrender value of the plan or whatnot is going to need to be purchased out of it, and obviously that can relate to a higher cost or some funding deadlines. So a lot of critical things you want to go over when you're considering life insurance in a cash balance plan. The important thing is you definitely can do it. Make sure you talk to us at Emparion or talk to your financial advisor or insurance agents to make sure you understand the rules.